to the fourth quarter 2019 Central Bank of Nigeria Monetary Policy Committee meeting holding here at the headquarters of the Central Bank of Nigeria in Abuja. The Monetary Policy Committee meeting um, met on the 19th and 20th of September 2019 for the third quarter review and communique presentation. And in the light of the softening global growth and weaker than anticipated domestic output, the community evaluated developments in the global and domestic economies and examined the outlook for the rest of the year. And of course, it noted the build-up of vulnerabilities in major advanced economies and its spillover to the emerging mass and developing economies, of which Nigeria is one of them. At the global economic development outlook, the output growth across major advanced economies remained subdued and confronted by legacy headwinds, including the subsisting trade war between the US and China, and of course other regional hostilities in the Middle East, rising debt levels, and growing uncertainties around Brexit and increasing political tensions between the US and Iran. Now, these are some of the global issues that affected the output for the third quarter 2019. Consequently, looking at the domestic economic growth indices, data from the National Bureau of Statistics showed that real gross domestic product grew by 1.94% in the second quarter of 2019 and compared with 2.10 and 1.50% in the preceding quarter. Anytime from now, it is expected that the central bank governor will begin addressing members of the press. It is also very important to note that at the last meeting, all the core areas indices were maintained. I'll now hand you over to the auditorium where the central bank governor, Godwin Emefiele, will begin to address the press on the outcome of this meeting.
I mean, conducive environments, necessary safeguards around investment, being able to repatriate, as it went due. And I think the central bank has taken some steps, especially on the FX side of things, to ensure that, like the INE window that was created, to ensure that those bottlenecks are reduced. But still coming back to the issue of foreign direct investment, just what are those bottlenecks? And when we make an investment case for Nigeria, because we've gone on a number of roadshows for the Eurobond and just going to get investors just come to Nigeria and just invest, not like it's not hot money, proper brick and mortar. We still have a few challenges. Share with us those challenges that you continue to see.
Like Roya said, there's a lot of concern around when they come in, what's the environment like? Like Bismarck has said, the ease of doing business. If an investor comes to the country, what are the bureaucratic challenges that they would face? So how easy for them to set up a company, to hire?
Mic is spilling. But are you okay? Are you okay? So I don't need that. So when am I to start? Okay. Good afternoon, ladies and gentlemen. Let me welcome you all to Central Bank of Nigeria. The Monetary Policy Committee met on the 25th and 26th of November 2019 in an environment of continued macroeconomic uncertainty, but gradual improvements in the domestic economy. The committee appraised the developments in both the global and domestic economies, as well as the outlook for the rest of the year and the first quarter of 2020. All the 11 members of the committee were in attendance at this meeting. Monetary Policy Committee reviewed the achievements of monetary policy in 2019, improvements in the domestic economy, particularly price stability, the development, improved credit delivery, low interest rate regime, exchange rate stability, financial system stability, reduction in non-performing loans, job creation and output. At the first meeting in January 2019, the committee retained the monetary policy rate at 14%. In March 2019, it reduced the MPR by 50 basis points to 13.5% and held other parameters constant in the first 10 months of 2019. Committee noted the use of homegrown heterodox policies used by the bank to successfully achieve substantial macroeconomic stability in 2019. Among the policies were the use of the Global Standing Instruction GSI to address the predatory impact of serial borrowers in the banking system, a phenomenon that reduced the level of NPLs over time, the loan-to-deposit ratio to post-credit delivery by the deposit money bank to the real sector, discounted cash reserve requirement, development finance initiatives in the agriculture, micro, small, and medium enterprises, and other real sector activities, including restriction of patronage by local corporates and individuals, investors in the CBN Open Market Operation Bill. The global economic environment. Global output growth remained weak due to the impact of the trade war between the US and China, growing vulnerabilities in the financial markets, downturn in global manufacturing, sustained volatility in oil prices, lingering uncertainty around the Brexit, which has continued to dampen investment growth in the United Kingdom, subdued growth in the European Union and Japan, and dampening output growth in China. These headwinds resulted in slowing global trade, weakening aggregate demand, and contraction in the aggregate supply chain. Major emerging markets and developing economies, particularly China and India, also slowed, while South Africa, Russia, and Brazil recorded even slower than expected growth. Consequently, there was a broad slowdown in global output growth. In the light of these developments, the IMF revised global growth forecast downwards to 3% in October 2019 from its previous projection of 3.2% in July 2019. Inflation in most advanced economies remained well below their long-run objectives, with price development staying subdued and unemployment trending mostly below the non-accelerating inflation rate of employment NAIRO. In the US, wage growth and aggregate demand continue to perform below the long-run average, even though unemployment remained below the non-accelerating inflation rate of unemployment. Consequently, the recent trend towards monetary accommodation by key central banks is expected to continue into the foreseeable future. In key emerging market and developing economies, however, prices trended upwards with the output gaps widening and unemployment remaining relatively high. Domestic economic development. Data from the National Bureau of Statistics showed that real GDP grew by 2.28% during the third quarter of 2019 compared to 2.12% and 1.81% in the preceding and corresponding quarters respectively. The improved growth was driven largely by performance of the oil sector, which grew by 6.49%, while the non-oil sector grew by 1.85%. The manufacturing and non-manufacturing purchasing managers indices also expanded for the 31st and the 30th consecutive months at 58.2 index points apiece in October 2019. Staff projections indicate that real GDP during the fourth quarter of 2019 is expected to grow by 2.38%, driven by the non-oil sector. Headwinds to these projections include continued high level of unemployment, mild resurgence of anticipated inflationary pressures towards December festive season, rising public debt, high level of insecurity, and slow pace of oil price recovery. Despite these headwinds, growth is expected to pick up on the back of recent actions to boost credit to the private sector through the recent loan-to-deposit ratio and global standing instruction initiatives, sustained interventions by the bank in selected employment and growth-enhancing sectors, as well as fiscal policy measures to support growth. The committee noted the uptick in headline inflation year-on-year from 11.24% in September to 11.61% in October 2019. This was anticipated as part of the seasonal end-of-year uptick in prices, but was further accentuated by the border closure and expected temporary food supply shock, which will adjust over the medium to long term as the economy increases investments in food production. Consequently, food inflation rose from 13.51% to 14.09% in September and October 2019, respectively. Core inflation, the underlying inflation in the economy, however, declined marginally from 8.94% to 8.88% in September and October, respectively. The decline observed in core inflation was attributed to the relative stability in the foreign exchange market. The Nigerian land borders were closed to address the incidence of increased cross-border banditry, smuggling and dumping, insurgency, and the illegal trade practices of neighboring countries whose economies had become dependent on Nigeria through smuggling through our borders. The bank's continued intervention in the agricultural sector is expected to improve medium-term food supply. Indeed, there has been reports of bumper harvest in some staples like rice, maize, to mention a few. Committee observed that broad money supply M3 grew by 5.72% year-on-year in October 2019, compared with 2019 indicative benchmark of 16.08%. Growth in net domestic credit moderated to 26.38% in October 2019 from 30.33% in the previous month. This was attributed to a significant reduction in credit to government in October 2019 to 85.99% from 114.79% in the previous month. Growth in credit to the private sector, however, improved to 13.08% in October 2019 from 12.49% in the previous month, reflecting the impact of the bank's recent policy on loan-to-deposit ratio. An increase in the absolute gross credit amounting to 1.169 trillion naira was recorded between the end of May and end of October 2019. Consequently, the manufacturing sector received 459.69 billion naira, the highest in 2 decades. This was followed by the consumer loans of 356.65 billion naira, general commerce 142.98 billion naira, information and communication 82.07 billion naira, construction 74.52 billion naira, agriculture, forestry and fisheries 73.20 billion naira, mining and quarrying 3.64 billion naira, and transportation and storage 3.09 billion naira, among others. The committee therefore urged the management of the bank to sustain its current efforts to improve lending to the private sector and to explore other initiatives to provide funding to other critical sectors of the Nigerian economy. In the review period, money market interest rates reflected the prevailing liquidity conditions in the banking system. Overall, monthly weighted average interbank call and open buyback rates fell to 7.87 and 7.22% respectively in October 2019 from 11.41 and 10.73% respectively in September 2019. The committee noted the persisting bearish trend in the equities market had started to abate in November 2019 and was pleased by the increased patronage in the sovereign bonds market. The all-share index grew by 2.41% to 26,991.42 index points on November 22, 2019, from 26,355.35 index points at the end of October 2019. Market capitalization also grew by 1.54% to 13.03 trillion on November 22, 2019, from 12.83 trillion at the end of October 2018, due largely to portfolio shift from government securities to the equities market. The MPC also noted the improved resilience of the banking system as the non-performing loans ratio declined further to 6.56% at end of October 2019 from 6.67% as of September 2019 and from 14.05% in October 2018. The committee, however, noted that this figure remained above the prudential bank benchmark of 5%, thus urging the bank to sustain its current efforts, which have created this exorable prudential regime. Outlook. Overall, the medium-term outlook for the domestic and global economies remain to be clouded with uncertainties associated with the persisting trade wars between the U.S. and its major trading partners, financial vulnerabilities, rising levels of public and corporate debts, pockets of geopolitical tensions, and weakening global output. However, the reforms underway in the domestic economy aimed at diversifying the economy away from oil over the last 3 years have provided adequate shock absorber to withstand the headwinds. However, the committee urged the fiscal authorities to invest massively in public works program and improve fiscal buffers to complement these efforts. Forecasts of key macroeconomic variables, however, indicate prospects of improved output growth for the economy. Based on recent revised projections, the economy is expected to grow in 2019 by 2.3%, IMF estimate, 2.1% by the World Bank, and 2.2% the CBN staff estimates. Committee noted the tailwinds to these developments to include sustained stable exchange rate, enhanced flow of credit from the deposit money banks to the private sector, expected improvements in tax revenue and efficiency in public expenditure, continued improvements in the business environment and activities, and the sustained intervention by the bank in the real sector. Committee's considerations. The committee welcomed the improvements in output growth in the third quarter of 2019, noting that the current direction of Purchasing Managers Index suggests stronger growth in the fourth quarter. It, however, re-emphasized the need for diversification to strengthen the productive base of the economy and reduce dependence on oil. Diversification has become necessary now that Nigeria has signed the African Continental Free Trade Agreement, AFCFTA. To achieve this, the committee urged the federal government to continue to improve the investment climate and ease of doing business to attract foreign direct investment. Particularly, the government should, as a priority, improve conditions for global auto manufacturers, including for aviation and rail industries, to invest in the country. The committee commended the expansion in manufacturing output, noting that it was a direct fallout to the policy on loan deposit ratio. The committee called on government to urge the Pensions Commission to improve the prudential requirements for pension funds to refocus their investment portfolio away from their traditional choice of government securities in favor of other viable long-term investments in real estate, manufacturing, agriculture, and indeed infrastructure. Moreover, the committee called on strong visibility of fiscal and structural policies to improve infrastructure and investment conditions in the economy. It expressed strong optimism that the current policies of the bank, in a regime of solid fiscal and structural policy support, will yield strong dividends in closing the current negative output gap in the medium to long term and place the economy on a sustainable and self-sufficient path of growth, of output growth. As a key pillar of economic diversification, the MPC directed the attention of fiscal authorities to the immense potentials of the gas subsector and the urgency to encourage horizontal integration through private sector participation. This, the committee argued, will improve domestic power supply and export earnings. On price development, committee considered the moderate uptick in headline inflation in October 2019, attributing it partly to an expected temporary shortfall in food supply because of the recent land border closure and rise in demand as the festive season approaches. Although it noted that the price increase was not unexpected, it serves as a cost of the closure, which is lower than the medium-term benefits. Consequently, it noted the need to drive down food prices through increased support for local production of staple foods, including rice, fish, poultry, palm oil, tomatoes, and etc. It also urged government to follow through with a sustainable policy on backward integration in the milk industry and other priority sectors of the economy. On the fiscal sector, committee identified the need for institutional reforms through policies that would automate day-to-day processes of key revenue-generating and security institutions such as Nigerian customs. This will provide additional advantage of stemming smuggling, kidnapping, and the migration of terrorists into the country. The MPC reiterated the need for increased efficiency in public expenditure and the building of fiscal buffers. On the impact of the recent closure of the Nigerian land borders on domestic food prices, committee noted that any upward price movement arising from the closure was reactionary and therefore temporary. Moreover, significant investment has been made over the last 3 years to sustainably increase domestic food supply. It noted some of the key initiatives in this direction to include the commodity development initiatives designed to finance the agricultural value chain of 10 commodities, namely cassava, cocoa, cotton and textiles, rice, tomatoes, poultry, livestock and dairy, fish, oil palm, and maize, which has received 171.6 billion naira in funding. 4 of these crops received over 140 billion naira, or 81.6% of total disbursements. Cassava 11.4 billion naira, cotton 40.47 billion naira, rice 53.4 billion naira, and oil palm 34.81 billion naira. It is therefore expected that the outcome of these interventions will close the supply gap already envisaged in the medium to long term, including dampening domestic prices. It therefore expressed support for the temporary closure of Nigeria's land borders, noting that securing the country's land borders should be further enhanced. On crude oil price, committee noted the lull in the futures market, suggesting that prices will remain relatively weak into the foreseeable future. The committee therefore urged the federal government to reconsider its 2020 budget oil price benchmark of $57 to the barrel to build buffers. Committee was confident that despite the weaknesses from the external sector, efforts to ramp up domestic production through several measures by both the monetary and fiscal authorities will douse the adverse effect on the domestic economy in the medium term through reduction of importation of food and commodities. Committee's decision. The Monetary Policy Committee reviewed the upsides and the downsides of the options to tighten, hold, or to loosen. It was conscious that while tightening may encourage capital flows, it also has the downside consequence of stifling of the already nascent recovery in output growth. The committee also noted that a reduction in policy rate will improve growth prospects, but in view of the uptick inflationary pressures, it decided that the balance of risk was in favor of protecting price stability. Considering the recovery, decline in market interest rates, growth in domestic credit, amongst other positive developments, committee felt that there would be more gains in the shortfall to medium term in holding policy at its current position. In its consideration to hold, the monetary policy noted with pleasure the positive outcomes of actions already taken by the bank. These actions include the current policy on loan-to-deposit ratio, which has resulted in loans and advances rising by over 1.1 trillion naira between June to October 2019. It further noted that these actions have assisted in boosting credit to the agricultural and manufacturing sectors, hence the positive outcome on the gross domestic product. The MPC is hopeful that the loan-to-deposit ratio initiative must be sustained as interest rates being paid by borrowers have so far dropped by up to 400 basis points between June and now. These have happened with corresponding decline in non-performing loans ratio to 6.5% at the end of October 2019. The MPC is therefore of the view that sustaining the MPR at its current level is crucial for better understanding of the impetus of growth before deciding on any probable variations. The MPC also feels that holding its current policy position offers pathways for appraising the effect of the heterodox policy to encourage lending by the banking industry without varying the policy rate, as the downside risk to growth and caution on inflation looks stable. The MPC is also of the view that the improvements in the macroeconomic indicators, such as the gross domestic product, the non-performing loans ratio, the capital adequacy ratio of the banks, as well as the loan-to-deposit ratio, suggest that the current monetary policy stance is yielding results. It therefore feels that maintaining the current stance will be necessary in order to sustain these improvements. In view of the foregoing, the committee decided by a unanimous vote to retain the policy rate at 13.5% and to hold all other policy parameters constant. In summary, the MPC voted to 1. Retain the MPR at 13.5%, 2. Retain the asymmetric corridor at plus 200 and minus 500 basis points around the MPR, 3. Retain the CRR at 22.5, and retain the liquidity ratio at 30%. I thank you for listening.
Distinguished ladies and gentlemen, that was the MPC communique as released today and as read by the Governor of the Central Bank of Nigeria, Mr. Godwin Emefiele. Welcome to the question and answer session. As usual, we have our house rules. You come up here, ask one question unless they are linked, unless they are really related, and we know how questions give birth. And then ask your question and then listen for the answer. Please, if you have questions, could you come close to me? Please, you have to come up here. Okay. Nancy, your name, your organization, and your question, please.
Good afternoon, Mr. Governor. I'm Nancy Naji, Executive Producer, Moneyline with Nancy. Let me ask this question. The capital importation reports that the MBS just released, it shows that perhaps Nigeria is not at an attractive place right now to do business because if we are going to be pursuing growth, we are going to be pursuing growth in elastic sectors that would create jobs. What perhaps did the MPC deliberate on that, and perhaps what's your advice to government? The other question is on inflation, perhaps as it also relates to border closure, because a lot of analysts and perhaps your critics or the CBN's critics have said that inflation would definitely continue if we don't have locally backed production to ramp up our supply. What is your response to that? And perhaps even as importers take their goods to other neighboring countries, what is your advice? Is the inflationary pressure in Nigeria, is it really a monetary phenomenon, a monetary condition, or is it as a result of supply shocks and output constraints? Thank you, Governor.
Thank you. Okay. Alonso.
Good afternoon, everybody. Board members, Governor. Alonso Soto.
Hold on, please. Yes.
Okay, Alonso Soto with Bloomberg.
Where?
Bloomberg. Yeah. Governor, we have seen this week that foreign reserves actually fell below 40 billion for the first time in quite a few years. We have seen reports of foreign portfolio investment outflows, and we have seen that the balance of payments has turned negative in the first half of this year. I wanted to ask you how sustainable is keeping the quasi-peg on the Naira versus the dollar, and what are the parameters?
Hold on, how sustainable is keeping the quasi-peg?
And what parameters is the central bank using to make that decision? If it is the reserves, if it is oil prices, can you tell us a little bit more about that?
What parameters?
Thank you.
Is CBN using to
Okay, Ambassador.
Governor, good afternoon. On the milk issue, you know that there's an intervention by the CBN to encourage the production of milk in the country. And can you give us the updates as to the response by those companies that are supposed to be involved in this transaction? Thank you.
Thanks.
hold on. Yes.
Nduka.
Good afternoon, Mr. Governor. In your address, you said that the MPL...
Press house.
Oh, sorry, the Nation newspaper.
Yeah.
Yes. In your address, you said that MPL is trending downwards. Recently, I just learned that MPL is around 6.5% sometime in October. What exactly is the CBN doing to assure Nigerians that MPL will remain low? Thank you.
Yes.
Okay, good afternoon, Governor Oyemwachukwu from Business Day. There are fears that the liquidity glut from the Omo glut is now kind of finding its some outlet in the FX market, leading to possible pressure on the dollars. Is this a real fear for the CBN, and how is the Apex Bank handling this? Thank you.
Okay, so those are the questions, and quite a mouthful. Quite a mouthful. Yes. So we'll listen to the governor now.
Wow.
Take the questions. Governor, sir.
Thank you very much. Nancy, on capital importation reports that show that FDIs are not increasing as they should be, and what is the advice? Well, basically, I think when you talk about FDIs not increasing, or you talk about that FPIs maybe exiting, I'd like to attribute that basically to developments in the global market. At this time, there is a significant outflow of liquidity away from the emerging markets, because people, foreign investors, particularly portfolio investors, are really finding opportunities in other markets. However, but it is important that we continue to keep our eye on that important stakeholder group, to ensure that we attract not just only foreign direct, not only domestic investors, but also foreign direct and foreign portfolio investors into our country. And that also means that a couple of what we call the structural inefficiencies that we see in our system, particularly the issues bordering on ease of doing business, making life easy for people who choose to come to Nigeria to invest their funds, whether portfolio investors or direct investors. We should make life easy for them, so that they will find Nigeria as an investment. They will see Nigeria as an investment destination. Critics feel He says that critics feel that inflation will continue to rise, and that what is the advice to government as people prefer to go to other countries. Well, the Monetary Policy Committee discussed extensively the trend in the rise in inflation, and what we found was that food inflation was a big problem at this time, but that the core was indeed dropping and satisfactorily. So what that means therefore is that there is a need for us to think about how do we really improve on food inflation, and we think that if this is taken more seriously, particularly at this time when the Central Bank of Nigeria, through its interventions, through the banks, as we continue to invest money in these sectors, that we will be able to achieve increased output for food, and as the output for food increases, prices will moderate downwards. You also asked what is the advice to government as people prefer to go to other countries. My first advice is that, well, whether we like it or not, the Nigerian economy is very, very important for us. And the growth of the Nigerian economy, which should be to create jobs and also to keep our industries alive, should remain a primary focus of government, and that we do not have any choice but to continue to take this very seriously. That also means that, by extension, we will continue to advise government to sustain the border closure, or whatever is being done that to make it easy for. There's a lot of interference. That government must continue to sustain the border closure to ensure that we use the opportunity of this closure to boost employment and also grow output, as well as keep our industries alive. Now, on the Bloomberg question, he says this week FX reserves dropped below 40, and that there are outflows of FPIs. But I think it's important for me to say that if you recall, during the period of the last crisis of 2016-2017, reserve dropped to as low as $23 billion even in October 2016. And yet we still managed our position, and we were able to get out of the situation. And so we're saying at even below 40, that our threshold is still very, very high, and that we do not have any fears, and there's no need for anybody to worry about.
Brought to you by Coronation Merchants Bank.
Can you show that this?
Hello. Okay, so that's the briefing from the CBN Governor Godwin Emefiele, who's been able to tell us that after due consideration by the Monetary Policy Committee, maintaining the monetary policy ratio at 13.5% has been
Nigeria. It's happening in practically all the emerging market economies today. And I said that during the period when we had the crisis of 2015-16 into from the early part of 2017, that reserve dropped even to as low as 23 billion. But we still managed and we survived. Yes, we do know that there's a focus on the fact that crude price is not as resilient as it was in 2018. We believe that crude price are today $63 to the barrel, notwithstanding what I can call a marginal drop in reserve below 40, is not enough to create any fears in any mind, and that our policy of sustaining the stable exchange rate regime will continue. Now, and then you are asking how sustainable is keeping the quasi peg on the naira. I have often said that there is no way you are going to find the hand of central bank intervening in the determination of the exchange rate. So it is not the right statement to say that there is a quasi peg on the naira. Like you know, the investors and exporters window trades at market. And you also know that the price at that market is not fixed. The price varies, moves from 359, sometimes trends upwards to as high as 364. And as more inflows come into the market, the price trends downwards. So to say that there's a peg, I think is a misleading comment, and I think it's good for me to really correct that. Central bank has no way of intervening in that market. The only way CBN intervenes in that market is either to buy dollar if the rate is low to a level where CBN feels it wants to buy, or sell dollar in line with the mandate float regime that we run today, to say you sell dollar at the rate into the market when prices get to a level that we feel we're comfortable with. That does not amount to a peg. And I think it's important that we correct the impression that there is a quasi peg. Milk. You asked for update that how are the milk importers responding to our appeal to them to backward integrate. We will continue to appeal to them, but I must say that the response that we have received from the milk industries is encouraging, because, for instance, we could see that the likes of Friesland and Campina, Promasidor, Ala, and a range of others, even Dano and the rest of them, have all embraced this policy by going to different parts of the country. Indeed, this morning, the Prime Minister of the Kingdom of the Netherlands was at the presidential villa, and one of the MOUs that was signed is between the Niger State government and Friesland and Campina. The essence of that is to demonstrate that Friesland and Campina has put its feet forward to say that we will backward integrate. Before now, the company has been involved in milk collection, set up milk collection centers in some southwestern part of the country, and in order to demonstrate that they are very serious about backward integration, themselves and some other milk companies have decided that they will run not only milk collection centers, but also set up their own dairy farms in Bobi in Niger State. I'm aware that, for instance, Campina has been allocated about 10,000 hectares of land, and we believe that this will help our efforts to save the effort that we currently spend importing milk into the country, which stands at over $1 billion annually. The nation talked about that NPLs are trending downwards to as low as 6.5%, and what is CBN doing to ensure NPLs remain low? You all recall that when we decided to introduce the low deposit ratio initiative, there was a couple of criticisms that will result in increasing NPLs. But we've held a couple of engagements with the bank, and we have told them we'll give support to the banks, and that resulted in the policy of the global standing instructions, where we're saying that if you take a loan from Bank A, and for one reason or the other you abandon the loan in Bank A, and you begin to operate your account in Bank B, that the central bank, by you accepting the offer letter and drawing the loan, that the central bank has the right to go to Bank B and take the money you have in Bank B to set off your loans in Bank A. That is a major shift in addressing the credit culture in the Nigerian banking environment, in Nigerian banking industry. And indeed, this was a major factor that helped to encourage the banks to now begin to consider increasing their loans. And you have seen, and just like we read at this communique, that the size of loans that were granted by deposit money banks between the end of June and the end of October is well over 1.1 trillion naira. This is encouraging, and indeed it helped a great deal in seeing to the fact that we have seen the output grow to the level that it is during the third quarter of 2019. We are going to continue to appeal to the banks to continue to work harder, to continue to grant credit to the private sector, particularly the agriculture and the manufacturing sectors of the economy, who very, very badly need the support of the banks. And we will also continue to give all the needed support from here at the central bank to not only the banks, but also any important step that desires to work with us in seeing to it that not just the large corporates, but also smallholder farmers in a rural community have easy access to credit.
Thank you, Governor, for apologizing to us. Just to add that the technical issues were as a result of our change of venue, and that next time it will be very smooth and seamless.
Let me, there was also a question on the border closure by Nancy. That what is the advice to government? I've responded to that. And ease of doing business, I've also responded to that. So I think it's more or less taken. Thank you.
Thank you, sir. It remains for me to thank you all for being so patient, and we promise that next time, our next outing will be better. Thank you so very much. Have a Merry Xmas.
We've gradually come to the end of the presentation of the communique, and part of the recommendations by the committee is the maintenance of the asymmetric corridor of plus 200 and over minus 500 around the MPR. And of course, the cash reserve ratio CRR at 22.5 and liquidity ratio at 30%. Now, these are some of the recommendations by the bank, and that is looking at some of the developments that have happened both locally and internationally that have led to some of these decisions being taken by the committee. The committee also considered reduction in pricing, but of course that could not happen because of possibilities of protecting price stability in the country. Well, that's the last MPC meeting for the year, and we do expect that by next year the MPC will come out with other very viable recommendations for the growth of the economy. From all of us here at the production studio, I am Chimobi Walter Naji, saying have yourself a wonderful evening.